We are, well, picking up a little bit. There's the Dow's good for about 60 points. S&P 500 is marginal winner today, as is the NASDAQ 10-year note yield 464. So given all that, Joe, best week of the year, bond yields really plummeted last week, and that was a big part of the story. Went 4 for 3.5 for 4 or 4 for 4, depending on how you want to look at it. What now? I think that's what everybody wants to know. What now?
Yeah, bond yields peaked just as CFTC data suggested that hedge funds increased their leverage positioning, short treasuries, to the highest level since 2006. So I think that that without question contributed to the pullback that you're seeing in rates and the positive effect on the equity market itself. The equity market, Scott, went from being deeply oversold to now being deeply overbought. And that's exactly where we are right now. I will say this about today. There does not seem to be this sense of urgency, if you would call it that, to be selling, to work off some of those overbought conditions. And I also think focusing on the Russell and focusing on some other areas of the market that recovered so strongly at the end of last week is going to be a good leading indicator as to which way we break.
I was just looking at the Russell, Weiss, as Joe was talking, because it's given back about 1.25% today. I mean, it's such a huge winner last week, up more than 6%. You just don't see that every day, every week, every year. I mean, it was a big move. Mike Wilson, Morgan Stanley. We'll keep an open mind, he says, but the move thus far looks more like a bear market rally than the start of a sustained upswing, particularly in light of weaker earnings revisions and macro data. You want to comment on that?
Look, well, no secret, Mike's been bearish for a while now, and I've been mostly in his camp. We don't know. Last week was an easy week, and it was an easy week because of just how quickly bond yields fell off. So it was going to bring a lot of people in worried that we're either short or sitting in a lot of cash. So last week was actually, not even in retrospect, at the time, it was a great market to trade. Joe and I talked about it. Excuse me. Now it's a little tougher because you've had the reset yields. Yields are now backing up today, but the market's holding it.
What are we rallying for? Why do we rally that much? Is it because the economy is slowing but not crashing?
A combination of events. It was the perfect storm positively for markets to rally, which was that you had a less hawkish, I wouldn't go so far as say dovish.
No, he was less hawkish, though.
Less hawkish, right, which was expected, but it was ratified because Powell has surprised us before when people expect him to be this way, and he finally delivered on it. Then you had a weakening of the data coming out, jobs number, inflation numbers, et cetera, but not weak enough to say that the economy is definitively heading to a recession.
But see, like Mike Wilson, for example, is like a good point on this. What he sees as a decided negative, right? The bears see this as negative, macro slowing.
Right.
Macro data is weak.
Yep.
Where the bulls would say, yeah, so it's still pretty good. And as long as it remains pretty good and not horrible, that's the definition of what
pretty
we
good,
want.
Right. Here's the difference. The difference is that the bears are really, in my belief, well, the bulls may say they're doing this, but they're not. The bears are looking forward, and they're saying, okay, we're finally seeing the hits of the economy from the massive tightening cycle. So we don't know why it didn't happen before, but it's happening now.
But the Bears have been singing the same look-forward tune for the last year.
Granted.
Recession's coming. Recession's here. Recession's next week.
Granted, but for the last year, look, they haven't been entirely wrong. The bulls haven't been entirely right. If you weren't in those 6, 7 stocks, you really didn't make money. As a matter of fact, if you were in sectors that were reliant upon the economy, like industrials or some of the other names, you lost some good money. So it's not as if the bears were so wrong. They weren't. In a market that goes up 80% of the time, I would tell you that if you handicapped it, the bears were dead right and the bulls were wrong. So aside from those 7 stocks, now here we are, the data is finally going the bears' direction. It's definitely slowing down. We're seeing that across all sectors, across almost all data reports, with the exception of the anomaly in retail sales a few weeks ago. And so that's what the bear case is. And if you have that case with high rates and multiples are still too high, so they've got to reset.